Good morning and welcome, everyone. This is John Person, and I want to say thanks to everyone who has joined us today. We are recording this, and so we're going to move forward, and we are recording this, so just so everyone, I see a lot of old names, a lot of friendly names, a lot of newcomers as well, so welcome. We were in Orlando at the World Money Show this past week. And it was as I talked about this in our own trading room yesterday, it was an extremist. It was like one of the first times that I'd seen an extreme reading from other analysts. It was either the market is still golden or there's an apocalyptic crash coming. It wasn't like, well, be selective and, you know, we might see a little grind lower in the next week or so. You know, we got to wait and see. There's still some strong sector. It was, you know, I didn't talk to every single person, but the few people that I met and that know me, that came up to me, I said, hey, what do you think? Because I'm a nosy busybody, and most of you guys that know me, part of the Peter Lynch style. You go to a store and you ask the clerk, hey, how's business been? You know, if you go to Macy's, if you go, you know, you look not for people to be in line, but look for people to see if they've got bags of purchases. There's a big difference. So anyway, those are the kind of things that we look for. We did a sound check, and I want to make sure for the majority of everyone that is here to make your time obviously worthwhile and quality. Is the sound adequate? I don't want to be too loud. I don't want to rock you out of your seat. It looks like everything is great. Also, we have Sonia Irwin is one of our premier students. We have a lot of friends here and past students and current students in the room. And if you have any questions, Sonia has moderating capabilities, and she can certainly help you out. And so we will talk about that. All right. So with that said, let's get cracking. Today's presentation, just as a quick reminder, regards the markets and trading does come with risk. This is an important disclaimer that everyone should read briefly. Especially I like the one about stop loss and stop limit orders, because they don't necessarily limit your losses, but the government never doesn't really care about the stop order as an entry, but still there's slippage. I think we should make this a little bit more effective for you and say that if you're using a stop order, sometimes the market gaps above or beyond your intended level, and that's what that really means. There's an enormous amount of slippage, fat finger issues. People discovered that. So there is no defined limit of stop loss, but stops are also used as orders, as we all see, to enter into orders as well. So it's important that everyone does their own due diligence, and before buying any stock, that you look into the company and make sure it's within the personality makeup of your financial outlook and what you're looking to do. Never buy more than you can afford to risk, and you always should adhere to proper money management techniques. Allocate a percentage of your risk or trading capital to any one trade, and not the trade itself, but the amount of risk that you're willing to take on that trade. So that's one of the important things that we need to remember. I'm going to give you a bit of history, and I know this might be boring. We're going to zing right through that. But for those that don't really know anything about me, and it was interesting in Orlando this past week that people came to the presentation, and there was, again, you know, there was no internet, so I was blown away. They wouldn't let me in the room on time because the lady didn't understand that I was a speaker. There were a few of you guys that were out there. That was funny. And so with that said, most people came to the presentation because they wanted to hear about scanning criteria and in using computers, and so that would insinuate that there was internet. The majority of the people in that 2-hour intensive workshop that I conducted had not heard of me before. One individual actually was using my indicator on toss and didn't know I had created it, and that was the PPS indicator, so it was kind of funny. Now, let me just go through with you a little bit of my background so that you know that you're not dealing with a novice trader, and some of you guys know that, but back in the early 80s, I did manage money too. I was actually sued for $500,000 by an individual because I made him $500,000 from $10,000 starting. He thought he should have made $1 million. It actually was a full-fledged CFTC reparation lawsuit. So it's actually the government has. It's not a positive thing to brag about, but boy, I'll tell you what. Les Rosenthal and myself, the clearing firm, Les was named in the suit, and we defended that, and it was thrown out. It was absolutely ridiculous. But you know, I've proven myself. I'm not a self-proclaimed guru by any stretch of the imagination. But here's the thing: I got into business, and I had a mentor, George Lane, who created stochastics. He's the one that really was instrumental in my career, and I started trading options when they were first introduced on Treasury bonds in 1984. So when the world wasn't really as now we see everyone's becoming options experts in the derivative, it's kind of an interesting game. But from my work in technical analysis, I was voted in. You have to be voted in. You have to be proposed by 3 other members of APTA, which is the American Association of Professional Technical Analysis. It's a very elite group of technicians, the top-tiered individuals in the world. I've had Series 3 and 30 registrations, and I've won gold trophies for my work in technical analysis, which a lot of you, if you're here today, have either seen, heard about, or use. I'm currently registered as a CTA with the NFA. This book at the top, Candlestick and Pivot Point Trading Triggers, it's about a decade old now, and it really did launch an innovative way of looking and popularizing candlesticks, pivot points, and even seasonal analysis, as I talked in the first chapter about looking at commodities and looking at ETFs. I was one of the first guys in the world to say, hey, look at the ETFs, especially the currency, FXE, which is in that first chapter, as well as looking at the seasonal aspects and related stocks to underlying commodities. We looked at soybeans, and we took a look at Archer Daniels Midland, Monsanto, Bunge, just to name as a few examples. I've had this last book here, Mastering the Stock Market, was voted 2014 the best investment book, and it's so important about my style of trading. The very first chapter talks about sector and seasonal analysis. This is probably these 2 books are probably my best combination works that will always stand the test of time. This Candlestick and Pivot Point Trading Triggers, it was what really launched the idea behind creating the person's pivot indicator. And we have several indicators and systems. The PPS, which many of you are family and friends of Thinkorswim, have found that on that platform. And if you're not familiar, this is the indicator that I created. I do education and live trading mentoring. So I was also the founder and creator of a Trading Triggers educational program. And partly, a lot of people have asked what's happened to the Commodity Traders Almanac. The Commodity Traders Almanac and the 2013 issue was one of the greatest issues I think that we ever wrote over the 8-year period that we did this book. And what had happened is John Wiley and Sons decided, since everything was going digital, Kindle, more people were buying it online, less people were buying the hard copy. They decided to go and change it from commodities to seasonal sector swing trader. And that is a quarterly publication available on Kindle, John Wiley, Amazon, and that the name has been changed because we were doing more stock and ETF than we were doing commodities in that book. But if you have the Commodity Traders Almanac 2013, it was a great issue. It was the best issue. I think if you have that book, the information there will also last for years. So hang on to that copy if you have one. All right. I was very honored and did not know about this, but Yale Hirsch, Jeff Hirsch's father, actually had reviewed my work for many years, and the committee at the folks at Stock Traders Almanac, the oldest financial publication over 47 years, dedicated the Stock Traders Almanac to me. This is quite an honor. This is actually the pinnacle of my career right here. I get goosebumps thinking about this, and I was floored. It was very emotional. I found out at the Las Vegas Traders Expo back in November, and an individual came up to me and said, hey, Mr. Person, would you sign this book? And I go, this isn't my book. And he goes, no, but you're in the book. And I go, what do you mean I'm in the book? And I looked at it and I said, oh my God. And I had to track down Jeff Hirsch and say, what, you didn't tell me about this. This is incredible. I was completely floored. So it was quite an honor, and I think it's just, you know, for my career in helping people. Jeff used to come down and he'd see me trade and sit shoulder to shoulder with me and has looked at my indicators, and I think that between that and the work we've done in the field of technical analysis, it was quite an interesting dedication. So let's get started. What can I do for you? I can help you achieve successful trading skills, and that's what I do. And I don't think there's people in this room that know me, that have taken any of my education, that have attended before, that can say that I haven't impacted their life in a positive way of their trading career in one way or another. So we're going to talk about that today. We do online and classroom mentoring educational program. We do live trading daily. We do look at daily swing position and future stocks. And the techniques that I'm going to share with you today, especially on looking at some of the seasonal outlooks on sectors in stocks and some commodities, which I think are very important this month, coming into February, has helped us achieve in an advisory service that I work with another partner. And by the way, this guy's name is Tom Asprey, and that's why it's called PA Stock Alerts. Tom Asprey, if you don't know his name, is probably another very famous technician. He actually created the histogram component of MACD some 30 years ago. So the combined efforts of looking at our stock picking techniques last year awarded us over 100.6% return in 2013. And in a year of 2013, when it was quite a very daunting market condition, the techniques that I'll share with you today is the same techniques that we used to look at some of those things. As a final announcement, we have exciting events. If you want to join us, we are going to do something this year that is never done before in a first-class arena. We're doing a trading mentoring ship at sea this July on the Allure from Royal Caribbean. It is the second largest vessel in Royal Caribbean. It is one of their newer vessels. I've been on this. It's the Eastern Caribbean. You go to St. Thomas, St. Martin's, and if you're looking for incredible coaching, trading, and personal mentorship at sea, it's July 20th, and it's the greatest time to go to the Caribbean. The breezes are great. The water temperature's awesome. It's not really, a lot of people get afraid of hurricanes, but hurricanes, it's really in September, October we worry about them. And we're really excited about this. And if you're looking for information on that, all you have to do is go over to our website, which is personsplanet.com. Just click over here where it says seminars right there. And just if you click on seminars, trading mentorship at sea, and you can find out everything about that and the deadlines, et cetera, and I think you'll be pleasantly surprised at the amount of time we will be spending and all the extra perks that we're doing at this trading mentorship at sea. So with that said, now that you know who I am and what I can do for you, let's show you some of our trading priorities. I've always was taught directional ideas. You've got to have an idea in order to figure out where a market might go, where the market's been. If you are an iron condor option trader and you think the market's not going to go up or down and it's going to stay within a standard deviation of a current price level, then you have a directional idea. And you better have had a good technical basis or at least some type of fundamental understanding of the market before you put money to work. And then your next step is to look at a trading strategy. Your third step is your execution. What's your entry level and what's your entry style? Are you going at the market? Are you stopping yourself in? Are you looking for a snapback? Are you using limit orders? Trade management. Where's your stop? What's your risk? What's your reward? And last but not least, your position sizing. We always joke around the floor in the old days, whenever you're right, you're always in 1. Whenever you're wrong, you're always in 100. And it always seemed that the guys that would blow up always had this, they got this gut feeling that they weren't wrong, and they would just powerball, and then the market, if they were buying it, would dip lower, and they'd add on, and they'd add on, and they'd just pyramid, and you know what? They were out of their careers. My indicators and studies that I use, first and foremost, I use seasonal analysis. It helps me anticipate market turns. It helps me anticipate based on history, because if you're like me and like most people, and this is a really nice test of, I think to go to the World Money Show and to come here in just a few days, I get a temperature gauge of the market. People have a habit of not remembering what they ate for dinner a couple days ago, let alone what the markets did a year ago. But if you recall, I actually polled the audience and I said, how many remember the first quarter last year that as the stock market was going up, technology was not moving in association with the broad market? And everyone's like, yeah, I think I remember something like that, right? And so that's where seasonal analysis and looking at the charts can help you understand in order to figure out where a market might go, where's it been. And looking at persons' pivots on multiple time frames helps us uncover hidden support and resistance values. For stock indices, we look at health and breadth studies. And one of the health studies that I use, and many people find this to be ineffective, is volume histogram bars. And there's another tool that we use, that we teach and coach people to use, and use it effectively, is an old indicator called on balance volume, created by Joe Granville. Breadth studies are advanced decline comparative ratio lines that we like to look at, and looking at the market internals, and that's what breadth studies means. Momentum, what does momentum mean? Where's the market currently as compared to past price action? Are you making a closing high for the week? Are you making a closing low for the week? Have you closed below a sideways channel, which might insinuate that the market's looking for a further breakdown? And then finally, us commodity guys would call it spread trading. Stock traders call it pairs trading, and real technicians call it comparative relative strength analysis, or RS analysis. So either way, these three things, these three ways of calling it, in the old days we just call it a spread chart. You looked at the notes to bonds, you looked at corn to wheat, you look at Coke versus Pepsi, etc., and you look at one sector to another to see if one sector is outperforming the broad market. And then with that said, we have this chart here, and this is a relative strength chart. Now, I've been teaching this to our community for a number of years and helped our students actually construct this several years ago. Basically, because this is very hard to read, the good news is it's all color coordinated up in here. And more importantly, I can go over and share with you what I want to share with you is when we get to this, we have, from a year-to-date perspective, let's take a look at this. We have Germany, which is EWG. We have Italy, EWI. We have the EWM, which is Malaysia, EWQ. We have ILF. We have the EEM, emerging markets, the S&Ps, and the Dow Jones Industrial Average. So we have France, excuse me, I forgot to mention that, and ILF is, again, Latin America. My apologies. So from a year-to-date perspective, what's been on the news over the last couple days has been emerging markets. Everyone would probably agree with that. Emerging markets have just absolutely sunk, but on really horrific news. And if you take a look at this, the emerging market is the EEM is this fuchsia color, and the reading says 38.19, if you could read that up at the top left screen. So everything's color coordinated in effect. The actual worst segment of the world is Latin America. Second is emerging markets. Third is Malaysia. Italy didn't really do a whole lot last year, so it's, you know, it's probably explains why it's not doing a whole lot right now. But we are negative in the S&P 500 by 3% on a year-to-date basis. So when we take a look at this relative strength, we're comparing where we are with the rest of the world. And as you can see, emerging markets with last week's sell-off, boy, this thing's gone from, it's already fallen almost 8% on a year-to-date basis. Now let's take a little further look-see and see really how bad things look, okay? The funny thing is, if you guys are looking at emerging markets, and a relative strength chart does several things. Number one, this is a 0% line. And so I know that emerging markets has been in the news, and last year you heard a lot of people talk about, you got to get in emerging markets, it's a buy. Well, why would a stock analyst tell you to buy? Because it was cheap, and he thought it would bounce up. And using relative strength, the true secret is this. You all have heard the term, money chases money. Bottom pickers lose. So let's take a look at this chart together and say, since the beginning of 2013, The emerging market has gone through a number of changes, and if you're not sure what some of the countries listed in emerging markets, I'll give you 3 of the top hotbeds in the world. Turkey, Syria, Egypt. Those are 3 countries in the emerging market index. So with that said, folks, you know, this is an index in a sector which I find, looking at the comparative analysis, I say, well, gee, it's had a lot of bad news this week, and if it's had a lot of bad news this week, it might be now actually when no one wants to buy it. Why isn't this starting to make newer lows and underperforming last year's middle low level? Now, looking at the Latin America sector, it is actually just completely collapsed. But when you take a look at where we are, where we've been, yes, we've seen a significant rally, and we're up there with the S&Ps in Germany. We're up there. This is the Dow. This is France. This is Italy. And then down here, these are the 3 worst sectors. But I would be honest with you, if we start to see positive performance and emerging markets start to increase and start to show positive performance, the fact that we have on a yearly basis, we have not taken out those lows. If you start to see higher highs and higher lows, and you start to get back to above 0%, boy, I'll tell you what, that's when you want to start looking at emerging markets. The fact that the emerging market segment of the market right now, and everyone in the world is saying how much trouble there is. This is an area that I think that from a standpoint of opportunity now exists, where I would say to you 3 months ago, 2 days ago, 2 weeks ago, I would say last year, in fact, in September, I gave a presentation to a group of professional money managers in Munich, Germany, and they weren't really interested in my calls that the industrials and the materials sector was looking good, and I gave them a trade setup about buying Siemens at 114. It only went to 136. But they were more interested in their position in emerging markets because they had invested in, and a lot of them were all invested their clients' money in emerging markets. So as you can see, they did recover some of their money, but overall, emerging markets, it's not the segment that you want to be in until you start to see positive performance. So the key for this market is here, A, we did not make newer lows on really bad news. That's a positive sign in of itself. B, if there are people in emerging markets and it starts to recover, then you want to focus in on this when we start to see a more positive trend in the emerging market segment. So that, I would say, could be a good opportunity at the ETF of EEM. And I know that you probably, if you listen to the news and you hear people talk about emerging market ETF, the EEM, I'll tell you what, this relative strength chart is going to really help you come up with your own information, and it does not tell a lie. So with that said, the sector analysis and relative strength, I wanted to take a look at in order to figure out with the true element of where the markets might go this month and this quarter. We got to figure out where the markets have been. And year to date, look, what's funny about this is that last year, automobile and components was the best performing sector, and they're the worst performing sector year to date. Now, this is a sector analysis of percent rate of return from the beginning of the year. We have, as you can see, banks are doing pretty well, real estate's doing pretty well, healthcare is doing very well, farm, bio, life sciences is exceptionally well, and utilities, which was the redheaded stepchild last year, is doing pretty darn good for an underprivileged sector of the marketplace. Underprivileged in the sense that it has a very low percentage weight to the S&P 500. Now, let me show you a construction of the top-tiered segments of the market. We have color-coordinated for your benefit. XLE, which is in, I guess, maroon. XLF, which is the diversified financial ETF. It is not a banking ETF, as I try to explain to people. The XLF is diversified in the sense that it has banks, it has a CME in it, which is a commodity exchange, It has American Express, which is a credit card. It even has MetLife, which is an insurer. So it is diversified. It's not a pure bank play. A real good pure bank play is this thing over here called the KRE, which is a regional bank, which, as you can see, is the worst performing sector right now, down 5.8%, the KRE. The funny thing is, guess what, folks? It was the best performing sector last year. It was up almost 43%. It was the best performing sector of the market. Regional banks were up 43% last year. If you had invested in utilities, you were up about 4%. If you invested in the regional bank and just that segment, that index, that ETF, that sector of the market was up 42% last year. Big, big, big move. And it's no wonder it's down 5.8%. But from a year-to-date perspective, I want to share with you a form of analysis that can help you identify changes in the market. So using relative strength, if this is the zero line, when a market starts to go back above a zero line, and then all of a sudden crosses under, and then all of a sudden it makes, just like with anything, it starts to make higher highs and higher lows. Now I want you to focus, it might be hard, but I want you to focus in on this pink or strawberry color, which is up 2.97%. Notice that it has actually been positive on the year, and this is healthcare here, so that you can see what segments of the markets have been positive and where do you focus in. Because remember, when a market starts to be positive performance and it starts making higher highs, you might not see it in the price structure, but you're going to see it in a relative strength chart analysis. And that's one of the things that you could keep a focus on for yourself and understand that if there's a segment of the market that's positive, guess what's going to chase it? Other institutional money. This is actually the XLU. Notice that we went positive on the year just around the 10th of the month. Now, this is a weekly chart on the XLU, and this is using our PPS indicator with an on-balance volume. The funny thing is that right at the beginning of the month of January, as you can see, you don't get a lot out of this chart, but from a relative strength perspective, boy, it is actually leading the charge. And by the way, this is as of yesterday's close. So the best sector of the market you could start to identify before you start to see any aggressive moves to the upside. You could say, gee, I want to start focusing in on utility stocks. Man, utilities are outperforming the entire marketplace. I think I want to focus in on utility stocks. Now, 2 weeks ago, we gave a lot of names. We do this with TradeStation every Thursday. We do it with our planning and scanning group in our room. And while we might not have a trade every single hour on a stock pick, but what we do is we select the sectors, and I share people and teach and train people what stocks are looking good. We gave out 2 names, PEG, which is Public Service Enterprise Group, not a big name, and I understand, you had some really high flyers this week, and I get that. But for low risk and high probability, that's what I'm looking for. And this was a nice little move to the upside on Public Service Enterprise. How did we come up with that? Well, first off, in the middle of the month, it's in a segment of a sector that is beating all other sectors, number one. Number two, it pops in with a high closed doji. Number three, it has another high closed doji, and it's in a PPS. But most importantly, look at, as the market is starting to turn to the upside, look at the on-balance volume indicator as it's starting to make a trend of volume showing there's participation in the move. So that's showing there's the leadership of that stock. We also had another one here, and this is Exelon, EXC. I've tweeted this out. We talked about it. As a disclosure, we actually took a profit on this stock yesterday, so don't be chasing this one. But the volume, even on a longer-term weekly basis, it started to show, based on relative strength, that this was the sector to be looking at in the last couple weeks as a defensive play. So what's the worst sector of the market right now? And it's kind of funny that over time, we have consumer discretionary from about mid-January going into the end of February. The consumer discretionary, which is the XLY, is probably one of the least best on average segments to get into. I mean, look at some of the names in here. Home Depot, Amazon, McDonald's, Disney. I mean, Disney, that's a tough one because Disney is in the consumer discretionary sector. Why is it tough? Because you know, they come out with movies, and when the wintertime, kids go to the movies. But they also have Disneyland down here. You know, I think pullbacks, this is the best time on the pullbacks. There's two ways to look at it. A, understand that the XLY itself has a seasonal tendency to peak out in January and through the month of February, and that's what we're here for. We're here to say, here's what we're looking at, okay? Now, you take a look at some of these names in the segment, and we say, well, here's Amazon. And by the way, Amazon generated last week a sell signal. And so by comparing to say, do I want to be buying stocks in this segment? This is the worst time after a major run-up in the market. It's not that it works every single time, folk. It's that it helps put the odds in your favor. And therefore, you might be able to use a little bit more you know, analysis and start doing some research on your own to say, gee, if this is a segment of the market that peaks out this time of year, boy, what stocks might be susceptible for declines? And then perhaps as an option trader, you could maybe look at some option strategies, credit call spreads, or at least look for some of these markets that might start to demonstrate weakness in the market. So when you get sell signals on Amazon, at the very least, you know not to be buying this stuff. And that is a PPS sell signal, by the way, in Amazon. Home Depot. Home Depot started to decline a little bit earlier. And, you know, I think that Home Depot is just some of the names that we see in this segment. Now, you could also look at Starbucks. But I've got a lot of information I want to go through with you for the month of February. So consumer discretionary is going to have a little bit of hard time in the month of February. And why we might see that is because I think if we go back to this chart, do credit card bills arrive from the holidays maybe? And people start to hunker down back to work. So there is some logical explanation. Now, I've had a lot of people ask me about gold, and if I was going to cover gold, and if I was going to cover the January effect, if I was going to cover the stock market, and the answer is yes, okay? So we've got a lot of information that we're going to try to get through real quickly here together, all right? Now, looking at gold, year over year, this is not a seasonal peak, that's an annual peak. This is actually one of the worst times, and this is what's scary about gold, because now there's talk about deflation in the world, in Europe, and gold is not having the same type of effect that it once used to. When the government was printing money and quantitative easing was printing money, people were buying gold for several reasons. A, they were afraid of government collapsing. They were afraid of Cyprus, the whole 9 yards, right? That was one of the things. We were afraid that the printing presses was going to create inflation. It was to replace the weakness in the U.S. dollar. There was a lot of reasons to buy gold. But right now, we're seeing the reverse effect with quantitative easing now starting to pull back. People are starting to say, gee, I don't know if I should be owning gold. What is the catalyst to own gold? Well, the fundamental events are there, but folks, this is a seasonal event. Since we've been tracking gold since 1972, the annual or seasonal high is made in between the third week of January to about the first week in February. And that's pretty scary if you're long gold. And one of the things that I would say is we've been trying to warn people not to be long gold, and I wanted to take a longer-term view of gold. In order to figure out where we are going to go, where have we been? And so since 2009, when the stock market was crashing and quantitative easing was increasing, the gold price rallied. Now that the stock market rallied and quantitative easing has been backing off, gold prices are moving lower. Now, if we take a look at this monthly chart, since this is the last, yesterday was the last day of the month, I thought it would be important to say, gee, if this is a seasonally weak period of time and gold couldn't even rally, I can't even imagine what's going to happen to gold over the next few weeks. But I can say this. Looking at the on-balance volume indicator, notice that we have a consecutive series of lower highs and lower lows. And notice that this is one little analysis here that I want you to pick up. We have a closing price that was lower last month than that prior declining level. And we did make a lower low in volume. That is not divergence. That's just confirmation that the trend is weakening. And so we have a monthly moving average, my proprietary settings here, and we have this overall descending triangle formation, just drawing off these highs right here. If gold, and I would be very, I don't know what the word I'm trying to use here. I would be very skeptical if gold, in order to get bullish again, would have to break out above 13. It's about 13.12, to be honest with you. We'd have to get gold, believe it or not, for me to get bullish longer term. We'd have to break above this descending triangle and the high of this, not this red candle, but this red candle here, and that would give me better, lower probability, but higher profitability, and then I would say it's a different story. But for right now, based on the fact that gold is in a seasonally weak period of time, I would look for and be very cautious with the monthly opening range. If you come back and start to see daily closes underneath that monthly opening range last month of January, and you start to see as if the market starts to decline, this is a very bearish pattern, descending triangles on a technical basis. And so what would be the next level of support? I would offer that this old high, if you notice here on the charts from 2008, the market had a hard time once, twice, and it finally broke out of that old high. It came back and acted as support. Markets tend to gravitate to those swing levels. Incidentally, notice this black line right here points out to that old high, and the area of the area, not the exact number because this is not an exact science, but the area. Notice that we have this little green two dots right here, and it says 1068. That is the person's quarterly pivot outlook. So for the not just the month of February, but also the first quarter of 2014, it's projecting, by the way, a lower high and a lower low, and it's targeting 1068. So if you are watching gold, watch for this past month of January, the opening range. If you trade underneath the opening range, which is almost very similar to last month's closing, December's closing price, and you start to see volume taper off with the on-balance volume indicator, then this is a very heavy pattern that suggests continued weakness, and possibly 1068, 1100 is your next level of support. Now, there is a chart I wanted to share with you, and it's the GDX, and I don't have it because there wasn't going to be enough time, but I will just state to you, and we'll carry this up with some of the analysis this Monday's planning and scanning, folks. But the GDX, just like when gold bottoms out in July, it's about a 30-day lag time that the GDX bottoms out in August, and that's the gold miners ETF index. Now, the same can be said about the seasonality of GDX. It doesn't go down about a month later. So gold futures peak out, gold prices peak out, the GDX and the miners tend to follow at about a 30-day window lag time. So you want to watch for the miners. If you see gold down and they go, look, the miners are holding up, this is bullish. Actually, that's a trap, okay? Gold goes down and the miners follow a month later. Don't get long the miners. Look for rallies in the miners through the month of February as liquidation or selling opportunities. So I just wanted to make sure everyone was crystal clear on that, okay? Treasury bonds. We have a huge public resurgent interest in Treasury bonds, people trading TVT, TLT, and, you know, from the life of history, on trading treasury bonds, typically we go down. And why do we go down this time of year? Real simple. Because people are buying into stocks, right? Stocks, the best time of the year to buy stocks is after the January swoon. You get the little liquidation of stocks in January. People take profits off the table to defer their capital gains taxes into the following year. And typically bonds are underwater. But when we're going through a situation where we're not sure about whether or not the stock market's going to perform, we get in a different situation. So you see the bond market actually going into about the first week of February actually tends to see a little bit of a rally. And then you see a continuation trend lower. So the next couple days is going to be important for bonds, and I have this chart for you right here. All right. This is a relative strength chart. This is relative strength analysis. This line chart up here is what we call the knob spread. It compares Treasury notes to U.S. Treasury bonds. Now, if you take a look at this level that I've marked up in here, these are the areas of old resistance. What we were looking for this past week, as I was looking for this high to fail and in a break of that trend line, just like we had back over here last October. Now notice when we were at this level, let's call it $8. It's the price difference between where Treasury bonds are trading and where Treasury notes are trading. So if Treasury notes are 125 handle and the bonds are at 133 handle, that's 8 full points difference, and that's what that spread reflects. At the very bottom of the at this chart, it shows the Dow Jones Industrial Average. Just as a kind of a funny proof in the pudding, so to speak, when bonds or notes go up, the stock market goes down. When the stock market goes up, bonds and notes go down. When the stock market goes up, then you see bonds and notes go down. When the stock market goes down, oh yeah, we're rallying. So we are rallying, and what's that got to do with Person's little seasonal analysis? Well, sometimes we start to see the bonds during the middle of January make a little bottom, and they tend to rally. Okay? They tend to rally because the equity markets tend to form that January swoon, stock profit taking. So what I'm suggesting is what I'm looking at, rather than looking at the absolute bonds themselves as a trade, we're using this spread or relative strength for two purposes: to help us uncover hidden differences between the relationship of the 10-year notes and the 30-year bonds. And if we start to see this trend start to erode and we start to see bearish patterns within the price structure internally between these two, it may give us a better clue that if we start to see this trend dissipate and fade, then the stock market, by theory, should bottom out. But meanwhile, we can look at this spread relationship for a trading opportunity which is a little bit more sophisticated than most retail traders are used to, because it requires the purchase and sale of two different products in a like market environment. A like market environment is interest rate markets, the 10-year bonds versus the 10-year notes versus the 30-year bonds. Okay? But it's a great indicator to help us uncover hidden support and resistance level, and we've got our eye on that as a not just a tool, but also a trading vehicle and a trading opportunity. All right. The best sector of the market that we enter from a long position going into the month of February, believe it or not, is energy. Okay? So, this is the energy sector XLE. And if you notice, we see a little bit of a decline going about the third week of January, and then typically we see energy increase. Let's take a look at the monthly and a daily chart of crude oil futures. And I got news for you, folks. If we're just entering a seasonally strong period of time, I'm a little bit nervous, because if crude oil is this strong, it means one of two things. Demand is outpacing supply, or we've outstripped there is no demand, and therefore there's no supply. I'm not sure which way to read that personally, but I can tell you this. This is the person's pivot support level, and we held it, and this is the person's pivot resistance. But do you look where you see it says quarterly? So this is for the next quarter. So let me ask you a question. If the market just got up to the 104 level, if we just got up to, let's call it 105, all right, and we take out this level, this swing high right here, just roughly around 101, we would actually be looking at a stronger market segment. So for the month of February, pullbacks will most likely be supported in crude oil and anything related to crude oil. So again, towards the middle to the end of February, for you stock traders out there, start looking at weakness in the OIH and stocks contained in the OIH for some better clues to the market. Now, the person's pivot indicator, and I can tell you this, when we take a look at the person's pivot indicator, it is predicated on a mathematical formula, which is the high-low close divided by 3. Now, I created this indicator. I did not invent pivots, but I invented an indicator around the pivots by using a moving average. Because one of the things that I noticed is every time the market was, if it was bullish, you know, we would see a higher high and a higher low. And instead of having all these support and resistance targets on my chart, you know, what we looked at was if the market's truly bullish, then I don't want to see it break the support level. If it breaks a support level, it's no longer bullish, right? Now, using pivots helps us uncover hidden values in the market. You know, this isn't done after the fact. This was done before the fact. I found it interesting that crude oil hits 92, bounces off that level, and now we're stuck right at this 98, which is that blue and that gold line. And if you notice here, the blue is the pivot point. It just is the true typical value of the high-low close of the last 3 months, and this gold line is a moving average. So even though the technical picture for this quarter is bearish, it's projecting a high up to 105. The seasonal, folks, the seasonal trend of the market is for February, the market to rally. So what we could take out of this is that if we get any breaks in the market from a technical perspective, the seasonal forces at play will probably show some undertone support. Refiners switch, demand picks up, we get winter travelers, we get that seasonal trend, we switch, refiners switch from winter blend gasoline to summer blend gasoline. There is a change in the system due to not just weather, but human consumption demands. Now, when we take a look at the on-balance volume indicator, notice that everyone can see that in January, this low was lower than the low in November. Does everyone see that? Now, if you make a lower low and there's no volume in that, as you can clearly see, this sell-off was extremely light because that was the week of Christmas. They just took advantage of that market. Look at the volume decline. Look at the decline in price. The price was severe. The volume wasn't. You would want to see, if this is a sustainable downside move, you would want to see lower volume readings making lower lows. And the on-balance volume did not do that. In fact, we've had what? From that high to that high is higher. From that low to that low is higher. This high is higher than that high, but not in price. So if we do get a pullback and it's not associated with any major declining lower low in volume, when we get another upsurge in price based on the seasonal aspect, this could be a move that could rocket itself back up for the rest of not just February, but the quarter to our projected resistance near that 104.60 area. So I wanted to leave you with today a couple ideas that, hey, let's take a look at gold. I know, I really don't care what the fundamental news is, all right? I mean, think of it. Do you really get accurate fundamental news? I mean, emerging markets are a great buy, and emerging markets go down forever. I mean, for the last 2 years, I've got a photograph from March. It was right around my birthday last year, March 19th. I was on my way to the Paris Technical Analysis Conference, and I'm at the airport, and at the Hudson in I think it was JFK, New York. I'm on my way to go to Paris, and here in the little newspaper stand, the Hudson Corp, I took a picture of this, and I guarantee you I could find that picture again because I've used it before in other presentations. On right next to each other was Barron's, and you can go back test this by, if you can go get a copy. I think it was the week of March 19th of 2013. Barron's said new ways to play emerging markets. Right next to it, not down 4 feet, right next to it was the Financial Times, and the Financial Times was saying emerging markets in jeopardy. Cyprus is blowing up. I mean, one newspaper was warning people emerging markets have problems, and the other American, Barron's, was telling people what great ways to get into emerging markets. That is the way the world works sometimes. So I don't know what the real information is, and I can tell you as a trader, I used to get these reports from the USDA, and you get the live cattle, and you get the cattle on feed, and it used to come out after the close, and you go, okay, feedlots and the placements and marketings, and you'd look at these reports, or back in the day when I worked with George Lane, when M1, money supply, M1, you guys don't even know what that is probably. M1 was important, and if M1 growth increased, it was inflationary, and so these reports, and the next thing you know, you'd go, well, these reports are bullish, and then the market would be limit down, and you'd be like, well, that didn't help me. I think there is what the market prices in. It's just like with earnings, folks. You know, you could see what the expectations of earnings are. You could look at Strangles and say, look, they're pricing in a 3% move, and it might be up, it could be down, and all of a sudden you get a 10% move, and it's no one saw that train wreck coming, right? So, you know, I think that it's important to understand what the real logical explanation of the market is to put the odds in my favor, because I don't have insider trading information, but I don't remember what I had for dinner a week ago. But I can look at seasonal analysis and say, gee, on average, year over year, gold peaks, crude bottoms, this happens, this segment of the market moves. I need to now be aware of that and see if there's money flowing into that sector, and I can do that by looking at a relative strength comparative analysis to see if there is improvements in the market. Does that make sense? Now, let me go through with you something that many of you may not have seen before or know about. This is the my charts on Trade Navigator. I want you to show you at the very top, this is daily charts. And you can see where it says daily charts right here. This is the S&P, that's the NASDAQ, that's the Russell, that's the New York Stock Exchange Composite Index, the NYSE, and of course we got the YM, which is the Dow. Now, I'm using futures on the majority of these markets, as you can see, ES stands rather than the cash market, to allow or to eliminate the gap in holiness, so to speak, of the cash market. So if I put up the spiders real quick, you can see we got gap, you know, it just looks a little thin. We don't have these full ranges. So I like personally to look at the futures market, since we trade these futures on a global scale. And if it's good enough for the news to report what the heck's happening in the futures overnight, I guess it's good enough for you too to look at. The next thing that we have is the advanced decline comparative ratio line on the S&P. Now, I think what's really interesting, and my partner with PA Stock Alerts, Tom Asprey, is probably one of the world's foremost experts in this type of analysis. And one of the things that's really neat is that, and it makes logical sense to people. Think of it this way. If you're trading a stock index that's predicated on the prices of all the stocks in that index, sometimes you get and it's a capitalized weighted index, meaning a few names can influence this index. I want it like Apple on the NASDAQ, Google, for example, Priceline. Some of these large cap names can have an influence and an impact on the index. So what I would rather see is, if the market is going down and we get a sell signal, are we getting a break of a lot of stocks in association with that? And, you know, that might give you a better gauge of the strength or the weakness in the market. And currently, we have a major weakness in the marketplace. In fact, we also have, looking at a daily chart, I want you to show you this, okay, we are making, as the market has made lower lows on a closing basis, and again, we didn't see that on Friday, we are starting to see deterioration on a volume, and we're starting to see deterioration with the on-balance volume indicator, as well as the amount of stocks deteriorating as well. So here's the cause for concern. Is this the Armageddon top of the market? Is this the end of the rally? This seasonal event, we have a January barometer, which suggests if the stock market goes negative in the month of January, so goes the rest of the year. Well, the funny thing is that we've got this arrow and we've got this yellow line pointed out, because this is the charts that I use in our own trading room. This is the analysis that we have. This is a targeted level of support that we were looking for the market to come potentially down to this week. It was a range, actually. We were calling from 65 to 50, and I know that's a 15-handle range, but, you know, in S&Ps, anything goes in this world. What I'm going to suggest to you is this, that we are trading right at the monthly pivot support. The monthly target generated, and this is interesting for you guys because this is why I love, like I said, new months. We have a target, by the way, on a monthly basis of 1743.5 on a monthly pivot target. It is giving us a lower high and a lower low reading. The funny thing is, it's not a substantial lower low. And I'm not going to get that ultimately bearish until we start to break. If you take a look at this level here, this line in the sand. So this line in the sand, until we start to break these types of levels with the advanced decline in the S&Ps and in volume, let's just draw this up for you. So comparing an apple to an apple, that particular day, which was December 12th, so that's December 12th, it's not just the closing price low of December, it's actually the market internals and volume. For me to get ultimately bearish this market, I need to see multiple closes below these levels. And this, if you can take a look at this yellow line, wouldn't that be a close underneath that line in the sand? And that's what I've got. So for the S&Ps, I think that we definitely see some weakness, and we probably need to chop around a little bit. But we have, again, a multiple personality schizophrenic market. What do I mean by that? Well, we've got, looking at the middle segment, which is advanced decline, we have an advanced decline on the NASDAQ. So let's take a look at the NASDAQ. The advanced decline is also not suggesting that we're taking out any substantial lows. Volume actually upticked in the last 2 days. So we have some actual interesting buying going on down at this level. So until we break this low, perhaps this becomes a bear flag, but it's not just the price that I need to look at, it's the participation level I need to look at. If we see the price down with an accelerated decline in the amount of stocks contained with that index, and the advanced decline on the NASDAQ is only 100 names, that's what I would say, then we have a change of sentiment for the market. Looking at the New York Stock Exchange Composite Index, Friday's action actually generated a doji. We made new lows, as you can see, but we made new lows, and this is kind of an interesting point of reference. We have a low here, you have a low here, and you have last week's area, and we're going to just draw up a line here. If you can tell, all the market has done is come up to this old level of resistance. So if this was at the time, if you take a look at that old level of resistance, so on this particular day, that close was the highest reading at that time with the advanced decline level. So look where we are in price, but look where we are in AD line readings. There's a whole lot of stocks in the New York Stock Exchange Composite that are actually more positive than we were at this level. So what I would suggest is if we break this low and the advanced decline is not even near this level, then it's not suggesting that the end of the world is here as much as it's suggesting there is some buying opportunity there and that the market has gotten oversold. If we see a break and the breadth of the market breaks these levels, that's when we turn the panic button on. So these are the daily charts. This is what the health, or what we call the breadth of each respective index looks like. So let's go over here and look at what's on the bottom. And what's on the bottom is a weekly chart. And while, yes, I agree, this is a pretty significant trend. And yes, I agree, this is a long in the tooth rally from 2000 and forget 2009. How about all this uptrend? But I could tell you this, on a weekly basis, if we see, and I think next week we try to test this low in here, and we got to look for maybe another newer kind of jab to the downside. But what I wanted to share with you is, if the market was truly bearish, then the point or line in the sand is that we're going to see a breakdown of that advanced decline level on a week-to-week basis. So what we do every week on Mondays is we have not open house, but we do a planning and scanning, and I reveal what is the health and the breadth of the market. And I know a lot of our community for day trading and for swing trading, it's been very instrumentally helpful. You can ask them. We have a bunch of our repeat students in the room right now. And I think last year it was this analysis that kept us more on the right side of the market. And we went, back in July, we went short and we were in TZA, and we went, we're not afraid of trading both sides of the market. Last year was a little tricky. I mean, but at this point in time, even though we have a weekly sell signal, we're at support here. And I'll tell you what, I'm still expecting a little bit of downside, but not to the point where I'm hitting the panic button to get out. In fact, we see opportunities, a sector rotational change in the market, and that's why we see names like Google. That's why we saw the utility sector. Not every name is going down in this environment. I would say I'm not going to jump in with any new fresh buying. Let's just get long everything here because we don't have that signal. Let me tell you what I will look at for a fresh buying signal, if you're interested. In order for this market to say it's going back up, we need to get back above. And as you can tell, we had a hard time at 1800 and 1808. 1808. I don't know what it is about that number, but I'll tell you right now, this is a number that I get more bullish on the market again, is if we can maintain daily closes above 1808. So you want to mark that down on your calendars. I'll type it in for you. Daily closes over 1808. All right? So daily closes over 1808, that's the big number there. You're above that high, you're above that swing low, and it's the breakout midpoint of this tall red candle. You get back above 1808, and you have an uptick in the on-balance volume and an uptick and a swing up, and you take out these highs on advanced decline. I got news for you, man. They're going to hit the buy button. That means you're definitely on the buy side of the market, and you stop selling rallies for day trading, okay? And so I think there is some really good technical tools that people may, if you notice, we haven't even looked at indicators out here. We haven't looked at stochastics, MACD, none of that. We're looking at the information that's exclusive to the indexes that I think is very important for traders to use. So you gotta, if you're trading and you want to trade successfully, you gotta trade by the rules. Feeling confident is derived from trading based on a plan and solid, sound information, and then executing on that set of rules and criteria. Success does not come from education. It comes from the right education, and I can tell you right now, I hope you got a lot out of this morning's session. I wanted to cover the segments of the seasonal outlooks for the month of February, the technical condition of the markets, the top markets that have strong seasonal trend reversals. That was the subject matter, and of course to introduce you to learn a little bit of my methods. Now, tomorrow is Sunday. And on Monday, we have our traditional planning and scanning, where I go through and share with you our scanning criteria. We look for scan setups in the market and what we're looking for in the marketplace. So with that said, if you'd like to join us for planning and scanning, email us at johnp@nadpersonsplanet.com or Sonia, and we will get you out some information. I wanted to also take a moment to see if there were some questions that we did not get to, or because a lot of times what happens, folks, is that you ask a question and I might get to it later in the presentation. So if you don't mind, just give me a second to browse through this font of 2. As you know, I'm not 25 years old anymore. I need to look at the font here. I got Bill Mack asking me, what about seasonality regarding the January effect? January effect in play now. The January effect, Bill, great question. The January effect actually starts to lose its impact in more bullish environment. That's a great question. Everyone ought to say thanks to Bill for even asking that question. Looking at the Russell, which is the January effect, simply is we take a look at small cap versus large cap. So there's a spread chart that you could take a look at. And if you, give me 2 seconds here, and let me show you something here. All right, so the January effect, it actually starts earlier in the year than most people believe. It would start, it was traditionally at the end of December going into January, thus why they call it the January effect. What it is the difference between the Russell and the S&P. So you're long the small cap, you're short the large cap, and you're looking for the performance or the spread or the relative strength to increase. So if you're long Russell, you're looking for the Russell to outperform the S&P. And as you can see, we are looking, and you see that occurring. In years past, we have seen where this spread relation starts in September. They get a lead on it. And another aspect about the January effect, or the small cap versus large cap segment of the market, by the way, is when the market environment is extremely bullish, people put money to work in high risk growth stocks like the Russell, the small cap names. They tend to outperform the market. In times of difficulty, guess what they do? They go for high yield, safe blue chip stocks and or utilities which pay a dividend. That's a defensive play. But overall, overall, the January effect starts to lose its effect as we get into early to mid-February. So like even as you can see, we are actually coming up to an area, an old historic area, that this spread, it's starting to get a little bit tired. It's been a little bit long in the tooth since November. And so you would want to be careful of this spread. And one of the, I think another way of analyzing the market to say, gee, is the stock market a buy? If the S&Ps, if this spread starts to go down, what does that mean? It means the S&Ps are outperforming the Russell. So from in mid to early February, Bill, that was a great question. Thank you. If we start to see the S&Ps outperforming the Russell, that's another little indicator or technique that you'd see that there's inherent strength coming into the stock market. So very, very nice question. Thank you all. Thank you very much for that, Bill. I hope I answered that question for you. We also have Michael Pritchett said PPS on tosses is a very useful indicator. Thank you very much, Michael. Let's review. If we don't get your question, we'll have an opportunity to ask it at the end of the webinar. Well, that's what we're trying to do. Let's see. Basil says, in this RS chart, are you comparing all the sectors against the S&P? I was comparing in two different charts, by the way, going back to that question so that you could see. This is the XLE. There are more sectors. These are the main sectors. I actually threw in the transportation, and yes, there's the S&P. So we are comparing the consumer discretionary, XLY, XLV is healthcare, U, utilities, P, staples, K, technology, I, industrials, F, technology, E, energy, B, materials, spiders is the S&P 500, KRE, I wanted to continue to watch the regional banks as well as the IYT, which is transportation. So we have to look at what segments of the market from top sectors, and of course there are subsectors. As you know, there's transportation. Well, what kind of transportation? There's air, rail, ship, truck, different transportation. Then there's service transportation like your FedEx and your UPS. So there's all different types of subsectors within that. But to answer your question, and I hope that did help you, the answer is yes. We were comparing most of the top sectors against the S&P 500. Thank you for asking that. What else do we have here? Will these charts be available? Do these relative charts work best in... Okay, I have not been able to create these. I'm sure TOS is possible, but I use Genesis Trade Navigator, and I've used it in conjunction with other platforms. I think everyone has their strengths and their weaknesses, and as TOS has probably an incredible community, you know, I love, it's like family, but so is Genesis, and I'm able to do a lot more with Genesis quicker and faster. And as you'll see if you join us on Monday with our planning and scanning, even our scanning criteria is able to put together some really neat information. And it's a phenomenal analytical package. Phenomenal is a key word. All right, so thank you for that. Outstanding investments recently so that China is determined to become the world's largest gold holder with prices exploding. Mort, that's great information there. With prices exploding, I'm sure prices are exploding past when you let me know when they get back over 2,000. And you know, I'm not saying gold won't hit 2,000 in my lifetime, but I think in this environment we've had a lot of reasons for gold to get to 2,000, and it never did. I'm saying right now, this is the worst time of year from a seasonal perspective to be buying into gold. And if the best time of the year was in the last quarter and gold couldn't rally that much, can you imagine what will happen to gold if it couldn't rally in its best time and on bullish news? What's going to happen to gold prices in the worst time on bearish news? That's all I would have to say. And with seasonal analysis, it's not a debate whether who's right or who's wrong. It's historic information that you might be able to utilize to maybe be a little bit more alert and cautious to your own holdings or trade setups. That's the key I think a lot of people miss. So it's not saying, hey, push the button and sell this day. Remember, technicals outweigh seasonals. Technicals absolutely outweigh seasonals. Seasonals alert us to what the market has happened in the past based on supply and demand functions. I always joke around and say, gee, how many people own a business? People raise their hands. I say, how many of your employees call sick with the flu in July? Not many. How many people call in sick with the flu anywhere between November and February? And like everyone gets the flu, right? I mean, they sell more Tamiflu this time of the year than they do in June and July, right? So obviously there's a change. There's more NyQuil commercials. You never see a NyQuil commercial, you know, the medicine that lets you sleep when you have a cold. You never see a NyQuil commercial in June or July, but they're running all the time right now. Okay? So I will have to say there is reasonable, logical supply and demand functions that we need to be focused in on. So I hope that helped answer that particular questions. And that David Kushner asked, why does seasonality work and do stocks have seasonal patterns? And the answer is absolutely yes. So I think that John Passmore, thank you for that comment. My book, Mastering the Stock Market, great discussion on seasonality in the different segments. John, on a daily bar chart, what time frame pivots should be used? Ed, I like to look at a daily chart. I like to look for stocks, monthly targets, okay? On an intraday basis, like 60-minute, 15-minute, I do use the dailies. The person's pivot indicator also gives you what the market condition is, and whether it's bullish or bearish. Please explain the difference between the cash and the futures market. Well, David, I thought we went over that a little bit with between the spiders and the ES. That pretty much, see if we can get one more question in for you here. George, when is the ideal time should scanning and planning be done to prepare for a new day? After the end of the day or the market closes, typically, and certainly before you start trading in the morning if you wake up early, okay? The Qs, Mark says Qs and TZA. All right, the Qs is the NASDAQ 100 exchange traded fund, and TZA is an inverse leveraged ETF off of the Russell 2000. So if you think the Russell 2000 is going to go down, then you would buy TZA. It's an inverse leveraged ETF. And I apologize for just rattling that off and not explaining what it was. Thank you, Mark, and I'm sorry for that if you're still here. Monday morning, we get planning and scanning. It's every Monday at 9 a.m. And if you guys are interested in that, I would strongly urge you to show up. We actually definitely record those as well and send those to people, but typically there has been times, because I'm not perfect, I am a human being, that I forget to hit the recording button. So with that said, I wanted everyone to also, if you have an interest in working together, this is going to be a great time. You come and just visit the website here at personsplanet.com. If there's, by the way, for those that had questions if you have questions on, in fact, here's planning and scanning. You can go to our website and just click on there and learn more about it. You can go to the store. We've got all kinds of things. We've got events and seminars and webinars. We've got all types of things. We have tools. We have articles. We have all kinds of great information on this website, all free of charge, guys and girls, ladies and gentlemen. Also, Twitter. I mean, I send out tweets. I mean, I don't send out tweets when I'm eating tonight or what clothes I'm wearing or anything like that. We talk about actual trades. We talk about potential setups that we're looking at. We talk about the events if you're not looking at them. And as you can see, we've you know, here's one. We just exited long position in EXC with a 7% gain. We just sent that out the other day. So, you know, if you're interested in tweets, again, I try to tweet things that are important, not to bog people down. You can follow our tweets and go through there. Another excellent tool for you guys to find out more about us. In the meantime, I want to say thank you guys. This is going to be a wonderful trading mentorship at sea. This is going to be fabulous, and I love getting together. We sit around, we talk, nothing but getting together one-on-one and finding out better ways of trading and sharing with other traders their successes and again, obstacles that they're getting over. So this is a great time. If you're, I'll tell you what, this ship, the Allure, I think has about 8,000 people on it. And, you know, for those that are seasick, I can't relate because, you know, for me, it's just I never feel the boat rocking, but neither here nor there. But we do have a great time, and this is going to be an exciting event. It's going to be awesome. So look forward to, if you guys are interested in that, you should certainly do some research on this and get together with us. In the meantime, we will see you back here if you're interested on Monday morning. And just as an introduction to what we do here, because I know a lot of people are seeking out the right educator, they're seeking out the right mentorship, and folks, I'm telling you, I can help you grab your hand and walk you through really great ways of improving your trading skills. So for those that are novices and those who have been struggling, I think there's a large community of people here that I don't think they would spend their Saturdays unless they're snowed in and listening to this if they didn't respect my work, or if I had, at least in the past, some positive influence in their trading. And I want to say thank you all for being here today. We'll see you Monday for Planning and Scanning. Monday